All right. Thanks for everyone joining. We will get started in 2 minutes. If you can hear us, please let us know where you're joining from. Peter, where are you joining from today?
No, I'm in Los Angeles.
What's the weather in Los Angeles? I say this out of jealousy as the Northeast is getting cold.
It's actually it's kind of chilly today. I'm sure it's warmer than New York by like 20 degrees, but
What's Chile is 60, 70, 60?
currently 65.
It's a tough life you
So it's
live. Tough
probably
life.
what's in New York? 64.
It's a good question. It's not bad
warm.
today. It's not bad. Today's like the warmest
Not
it's
bad.
been, and tomorrow we get down to 26. So,
Yeah, okay.
but just as a quick heads up, as we see more people joining, we're going to get into essentially end of year capital gains tax planning opportunities in a little over a minute. We're just giving people another minute to join before we get started. And again, if you can hear us, please let us know. Let us know where you're joining from. So. Okay, perfect. We're going to get started. So first of all, I just want to thank everyone for taking the time to join us today. We know everyone's got a busy day, end of year, trying to get things done. Today, we're going to focus on capital gains tax planning opportunities and what are those top opportunities to take care of before the year ends. Now, hopefully is not a surprise for most folks, but in the U.S., your tax year is based on the calendar year. So if you want to take advantage of opportunities in almost every scenario, you have to finish up whatever you're doing by the year end. There's a couple of exceptions, but most of the stuff you have to get done by December 31st. And as an FYI, whether it's if you're interacting with banks, there's holidays, things move slower, there's a rush. So getting started sooner, i.e. now, versus later is really beneficial. So this is really for people who have capital gains, appreciated assets, or have already realized capital gains, or working with clients who may have that and want to make sure they're optimizing and minimizing their taxes before year end. And just kind of as a quick introduction on ourselves. So Peter and I are both from Valur. Valur, what we do is we help people understand. The real idea is helping people take advantage of the same tax mitigation opportunities that a billionaire and their family office bring to their clients. We really want to help you understand what are the best practice tax mitigation opportunities, whether it's for income taxes, capital gain taxes, or estate taxes. Help you understand what are those options, the best practice opportunities, the benefits and trade-offs, whether on a qualitative or quantitative basis. And then we use technology to really automate and make it easier to understand these opportunities, set them up and administer them in an optimized manner at really kind of in real time and at no cost. We help people set up these trust structures or other vehicles at no cost, and the administration is typically 20 to 30% the cost of competitors. Peter, do you want to go just a quick background on yourself before we get started?
Yeah. So my background is I'm actually a trust and estates attorney. I joined Valur about 10 months ago now from a law firm, and I'm head of estate planning here. And so I'm working on sort of the more on the trust side of things. Yeah.
So I'm Monty. I founded Valur. This was based on a personal situation of I was fortunate to be part of a startup that did really well and IPO'd. I lived in California at the time. I was trying to figure out how do I maximize my exit, and that really came down to minimizing taxes. And was just surprised at how inaccessible it is to understand what solutions are out there, their benefits and trade-offs, and then just the cost and time of setting up and administering these structures. Really started Valur to to make that easier so that everyone can access and utilize these structures to better and more effectively reduce taxes and build their wealth. And so, we do a lot of free education. There's no cost to talk with us, and we have these weekly webinars. So one, we're talking about all sorts of topics from ordinary income, capital gains, estate taxes. So always please let us know if there's other topics you want us to talk about. And also in the chat, let us know if there's questions related to what we're talking about or this subject. We'll either address those in real time or at the end based on when makes sense. But the more questions, the better. So we'll jump into it here. So today we're going to really be talking about capital gains tax planning opportunities. And a couple of those things we're going to focus on for year end are tax loss harvesting, starting from the basics of tax loss harvesting, charitable gifts. We'll go through different ways that you can do charitable gifts, from purely altruistic with some tax benefits to the primarily selfish that benefit you and do have some charitable aspects as well, and in particular focusing on charitable remainder trusts. And then we'll also focus on, if you've already realized capital gains, what are some opportunities that are available? Just as an FYI, if you have appreciated assets, there's a lot more and higher ROI opportunities you can do if you plan before you sell the appreciated asset, but there are some things you can do after the fact. And then some other what are some other capital gains optimization opportunities you can do before the end of the year, and then leave some time for Q&A. So let's jump into it of tax loss harvesting. Peter, do you mind just giving kind of a quick introduction of what tax loss harvesting is?
Yeah. So the general idea is, the most common context here is stocks. So let's say you have a taxable portfolio, and you have 100 different stocks, and 80 of them have gains and 20 of them have losses. You could sell the 20 that have losses, and then sell some other stocks that have gains. And even though the stocks that you sell that have gains, the losses will offset the gains, and then it'll sort of cancel out. So you won't have any tax liability after selling both the up shares and the down shares.
100%. And this is where, we're going to assume everyone knows this, but, when you sell appreciated assets, you have capital gains taxes to pay. And because of the benefits of compounding, and surprisingly, paying less taxes today is better than paying taxes today, because you can reinvest that difference. And really the idea here is, if you can, through offsetting your gains with losses, you can avoid paying taxes today. You can save what you would otherwise pay the taxes and reinvest that money. Do you want to we'll avoid going too deep into kind of wash sales, but maybe do you want to talk about tax gain harvesting? Because it's the other side of the kind of equation that people are less familiar with. A lot more people here talk about, and sometimes it just, before we get to that, people do sometimes see, it's like, certain stocks people will see drop at the end of the year because people are tax loss harvesting, or, hey, look at your portfolio, see what our losses, sell them so you can offset your already realized gains. And so this is a little bit more apparent for folks, but less apparent of what can you do on the tax gain side.
Yeah. So the idea here is, let's say you're recently retired, and you don't have very high income anymore, but you have a lot of appreciated stock. One thing you can do is you can just sell stock. You might actually be in a much lower tax bracket than you realize. And so, let's say you used to make $400,000 a year, and now your income from dividends and stuff is like $60,000-$70,000 a year. You might actually be able to sneak below the capital gains. You might actually be in the 0% capital gains bracket, and so you might be able to sell appreciated assets and not pay any federal tax, or you might be in the 15% bracket, in which case you'll be paying tax, but not at super high rates. And so sometimes it's advantageous to just sell stock outright. Monty, you're on mute.
This is just a basic one, but it's important to, I think, Peter's point, people overlook tax loss harvesting and tax gain harvesting. It's just an important thing to look at your portfolio. We'll probably say this a lot of times. There's this phrase called don't let the tax tail wag your dog. So it doesn't mean necessarily sell stocks just to kind of do this. You want to make sure that you're selling the stock because, one, you want to sell the stock, and then figuring out, hey, can I do this in a tax optimized way? If I'm selling some stocks because I'm overly concentrated and I also that are up, and maybe I also have some stocks that I want to sell and they're down, just doing that in a coordinated way of doing them both this year versus one this year and one next year. So that's kind of the basic piece there. Now, charitable gifts. I'll jump into this one. So this is I'm sure people have heard of this as giving to donor advised funds or foundations or causes you care about, like the Boys and Girls Club. This is something that is primarily altruistic in nature. And it is interesting unfortunately, we do hear people who make a mistake about this, of people sometimes mistakenly, there's a lot of people who want to give to charity for purely altruistic reasons, which is great. But we do sometimes see people who think by giving their appreciated asset to their donor advised fund or a foundation, that they can actually selfishly come out ahead. And Peter, maybe let's walk through, how does the math work of, let's say someone here has NVIDIA stock and it's, cost basis, to make numbers simple, is $0 and it's worth $1 million to make numbers round. How would that math work out between their options of if they just sell it and pay their taxes versus they give it to their donor advised fund?
Yeah. So if they sell it and pay their taxes, depending on
let's assume they're in California.
Let's assume they're in California and they're in the top federal capital gains bracket. And so they'd probably be taxed at around 36%, depending on exactly where they are. And California taxes probably around 36%. And so that would be, $360,000 of capital gains tax, which would leave $640,000 left over after tax. But if instead they donated that $1 million to charity, they would get a tax deduction, which could offset ordinary income, not just capital gains. And so they might be, in for ordinary income purposes, between state and federal, they might be in the 47% bracket or something like that in California. And so they could essentially they get a deduction that would offset about 47 cents for every dollar. So, you gift $1 million and you essentially get a tax break that could be worth as much as $470,000 in this example.
Let's just round it and call it 500,000.
Let's say $500,000. So you're still out $500,000. Whereas if you
just to reiterate, just to reiterate this, because sometimes people do make a mistake on this. You have $1 million stock, if you give that away to charity, at best you're saving $500,000 in taxes. So on one side, you gave away $1 million and you're saving $500,000 in taxes. You are definitely down personally $500,000. Now that may not be a bad thing because you want to give to charity, but if you're solving for your own kind of financial needs, you're definitely not coming out ahead. Is that right, Peter? You have to be altruistic for that to make sense and believing in what you're giving away the assets to.
Yeah, a lot of times. So it depends on the structure.
Run through this
so
situation.
Structures we'll talk about, you actually can come out ahead potentially.
Yeah.
But the typical charitable gift, where you're just giving money to a donor advised fund or a charity, you're not actually coming out ahead personally. Between the benefits that you get, the tax deduction, and the benefit that the charity gets, it could easily be worthwhile. But it's not it doesn't make sense if you're not valuing the charity's benefits.
Yeah, exactly. And this is where we have a kind of couple of opportunities here of, now, one key thing is generally when you give to these charitable entities, you do receive an upfront tax deduction, even if the money's not given to charity this year, next year, or even let's say for your lifetime, you're getting a charitable tax deduction today. It is better to gift, if you are altruistically trying to do this, or even non-altruistic trying to do this, you'd rather gift the appreciated asset before you sell it to charity versus selling the asset, having to pay the taxes, and then gifting money after you pay taxes. Those are some kind of like basic pieces there. Now, we would segment these into some of the common charitable entities that people give away to assets to are DAFs, which there are donor advised funds, foundations. If you give money to those are really altruistic in nature, where there's the personal benefit is much smaller than what you're giving away. So you have to believe in the cause that you're giving away to. There's also vehicles called charitable remainder trusts and charitable lead annuity trusts, respectively known as CRUTs and CLATs, which can also be personally beneficial and have a charitable interest involved. That's kind of any pieces you think we're missing there, Peter, as to how to think about these charitable gifts. One of the pieces to call out is if you gift the asset and the transfer has to be completed by December 31st to get the charitable deduction this year.
Yeah. Yeah. I mean, I guess one other thing I would say, and we're going to talk about CRUTs on another slide, but donor advised funds, CRUTs, and CLATs can all be set up before the end of this year. A private foundation can't be, just because, it would be very hard to set it up before the end of the year at this point, because it's already December 11th. And so realistically, if you haven't started setting up a private foundation this year, you're not gonna have it set up by December 31st. But the other three you actually can set up before the end of the year if you wanted to.
That's a great point. We'll just kind of move on to so donor advised funds, private foundations, or your real goal is altruistic. Charitable CRUTs and CLATs can be selfishly motivated with a charitable aspect involved. CLATs are the common use cases. You're worried about gifting estate taxes and trying to pass on assets to your kids or future generations while minimizing estate taxes and giving to charity. We'll dive a little bit more into CRUTs, which are also known as charitable remainder trust. This is more of a common vehicle we see. This is one of the go-to best practice strategies for selling appreciated assets. This is used from everyone from Phil Knight when selling his Nike shares to a lot of folks we're seeing right now sell NVIDIA shares or other appreciated public stocks, crypto, real estate. A charitable remainder trust it's very similar to an IRA account. It's a tax-exempt vehicle. And the practical impact of that is it means you can contribute assets to the CRUT, sell them tax-free, reinvest the money pre-tax, and have the money grow pre-tax, and only pay the taxes when you pull the money out. And when you pull the money out, the taxes you're paying are typically long-term capital gains. It doesn't change the income from capital gains to ordinary income. And the real core benefit is that by not paying the taxes today, you get to reinvest the money, and that deferred tax money reinvestment creates more wealth for you over time. It's kind of any key pieces that I'm missing there as to who it's for, the key benefits, Peter?
No, I mean, it's like you said, it's super powerful on a long time horizon. The tax deferral yields pretty significant returns, especially if you're assuming a decent rate of return on your assets, like above let's say 6 or 7%. And the sort of the end of the year hook here is if you're thinking of selling appreciated assets like stocks or crypto, if you're thinking of selling, in the next 6 months or so, it might make sense to make the transfer in December to offset 2024 income. Because if you wait until 2025, you'll only be able to offset 2025 income.
Yeah, it's a really great point. Again, this is a primarily selfish structure, but you do typically receive about 10% of the value that you contribute to the trust as a charitable deduction in the year that you gift the money to the trust. And that money is not given to charity for many years, typically at the end of your life. And just to we're talking about what are the benefits of the structure. We're just jumping into a calculator. This is free on our site. We'll add the link in the chat. But taking a scenario where 40 years old, you live in California, you have an asset that's worth $100,000. Sorry, the cost basis was $100,000 and is now worth $1 million. You're married. We're assuming these assets grow at 8%. You can increase that or lower that depending on if you're more aggressive or conservative with your growth expectations. But what you're going to see is if you set this up just for your lifetime, you can see this is using this vehicle and just deferring the taxes and then reinvesting that money. you can create essentially $2.7 million of additional gains over your lifetime after taxes. And this is really the benefits of tax deferral. And kind of as Peter mentioned, the longer that you do this, the higher the ROI. So I'm just going to change some of these kind of assumptions. So this is for, if you do it for 20 years, the numbers, it's roughly $270,000 versus the longer you do this for, the higher the ROI. And really, again, there's a famous quote of, compounding is it's the 11th wonder of the world. I may be screwing up which wonder of the world it is, but really simple math here is the longer your assets can grow tax-free, the longer you defer paying taxes, the more wealth it's going to create for you. And this is just one of kind of many capital gains tax planning strategies. I say one thing is if you're just exploring this, we also have this tool called the guided planner, where if you're not sure really what you're solving for, you can kind of jump into this and just answer a couple of questions of, again, have you realized you're solving for capital gains? Have you realized this, not realized this? And with kind of picking kind of what type of asset is, you can pretty quickly kind of understand what are some opportunities that you have and understand some of the trade-offs, the benefits that you have with this pretty easily. So everything from if you're looking to understand what are some of these best practice strategies for these appreciated assets and understanding how they work, their benefits, to evaluating the ROI, we make it pretty easy. And in our follow-up email, you'll see a lot of some of these materials. You can also feel free to chat with us at any time. So we'll just kind of jump into this now. I would say there's a lot of benefits when selling appreciated assets with Charitable Trust. The ROI tends to be higher the longer you can set the trust up for. And again, the longer you can defer taxes, reinvest it, the more wealth it creates, the higher your tax rate. So if you live in California versus Texas, the more taxes you can defer, the higher the ROI is. And then the other part about this is the better you can reinvest and grow your assets, the more beneficial it is. The big trade-off with the Charitable Trust is you can only pull out its liquidity. You can only pull out a certain amount of assets each year. So if you need to buy a home in your first year with these proceeds, it may not be a good fit. But if you don't need that money for a while or just need some of that over time, then it's a better fit. One other important piece to call out is if you're selling something, you don't need to put it all inside of the trust. You can put some of it, all of it, part of it. That's really kind of more based on your personal situation. The kind of next opportunity that we'll talk about is kind of already realized capital gains. Now, again, as we mentioned, you have more options, higher ROI options, more flexibility if you do some of this tax planning before you sell the asset. But even though you have limited options, there are still some available if you've already sold the asset this year. Peter, want to kind of maybe jump in and kind of talk through these at a high level?
Yeah. So at the high level, real estate, a lot of people are going to be familiar with. If you have an investment property, let's say you're a real estate professional, which requires 750 hours a year, basically, of real estate work. But let's say you work in real estate anyways. You're a real estate professional. You could buy an apartment building, maybe a fourplex or duplex, and you can depreciate the building the year you buy it potentially, and you can use that depreciation to offset some of your W-2 income potentially. If you're not a real estate professional, it won't offset your W-2 income, but that's an avenue available to people who work in real estate. It can be really powerful. The second one we've already discussed, but charitable deductions. You can donate assets to charity in order to get a deduction that'll reduce your adjusted gross income. And then the third one, which Monty will go into in more detail, is oil and gas investments. Actually, I'll go into it in more detail. So oil and gas investments are the basic idea is that you invest in a fund that invests in oil wells, typically in West Texas, and you invest in those wells. You get a share of the depreciation from the wells, and you also get a share of the income. So in practice, you can depreciate about 93% or so of your investment in the first year. Um, and then you also get cash flow from the investment, and so they shoot for around 100% return, cash on cash return in the first 3 or 4 years, and then another similar return over the remainder of the duration of the investment, which is usually I think about 15 years. And so you can get significant cash flow, and then in year one, those deductions are worth, 93% deduction. If you're in a state with high taxes like New York or New Jersey, it's potentially 40 cents on the dollar or 45 cents on the dollar. So if you invest $100,000, you might get $45,000 in tax benefits the first year, and maybe $200,000 of cash flow over the length of the duration of the investment.
Yeah, and perfect. And as I was saying, it's like, these are different options. They have trade-offs in terms of involvement or non-involvement from a time perspective. And again, part of this is once you already realize these gains, you have less options from that point of view. One of the pieces I want to call out with charitable deductions is there's often a limitation of how much of your income you can offset with charitable deductions. Typically, it's about 30% of your income if you're using appreciated assets for your charitable deduction, but it can be up to 50% if you donate cash.
Yeah.
So
60% with cash, actually.
Sorry, 60% for cash.
Yeah.
All right, we'll get into kind of some other tax optimization options that we often see people focusing on. So all of these are focused on trusts versus kind of some other areas. But so intentionally defective grantor trusts, I'll give the kind of the overview, and Peter, you can jump into kind of the quick optimization piece that people should take care of. Intentionally defective grantor trusts, they're really used for people worried about gift and estate taxes, and most commonly used by families that are significantly over the lifetime gift exemption. There's actually a recent New York Times article about Jensen Huang, the founder of NVIDIA, who uses intentionally defective grantor trusts. Unsurprisingly, if anyone's following the news, NVIDIA is doing really well. Jensen Huang and his family are significantly over the gift and estate tax. They're using intentionally defective grantor trusts to help mitigate their estate taxes and pass on as much as possible to future generations. Now, we have a separate webinar and video you can watch online about how these structures work. But Peter, let's just assume that someone here has an intentionally defective grantor trust. What are some of the things that they should look to do before the end of the year to really optimize it?
Yeah. So on the capital gains front, something that you could do which is relatively simple, and you can even do through Valur if you have a Valur trust, is you can swap out the highly appreciated assets in the trust for assets that you have personally that are much higher basis. So, why would you do this? The reason is that these intentionally defective grantor trusts don't get basis step ups when you die. Basis step up is so basically to give you context. When somebody dies, any assets that they own personally or sort of in their name get stepped up to fair market value. So if you have stock that's super appreciated, when you die, that stock will get stepped up to whatever the fair market value is. The basis will be stepped up. So your kids can sell the stock and not pay capital gains tax after your death. Your irrevocable trusts don't get that benefit in most cases, and so you sort of have this capital gains issue with irrevocable trusts where they own highly appreciated assets and they won't get a basis step up when the grantor dies. And so a way to mitigate that is to do a swap before the grantor dies. And so if the trust has highly appreciated stock or crypto or whatever it is, and the grantor has cash or bonds or other high basis assets, the grantor can swap those high basis assets into the trust in exchange for the low basis assets. Doing that doesn't cause any capital gains immediate, like there's no immediate tax consequences. But what it does is it gets the low basis assets into the grantor's estate where they'll experience a basis step up, when the grantor dies, and they get the high basis assets that don't need a basis step up into the irrevocable trust.
Perfect. Yeah. And this is really how do you take advantage of step up? Because it is such a powerful, I mean, I don't know if this is the right framing, but it's a get out of jail card for capital gains taxes when you're kind of approaching end of life scenarios, is move those low basis assets into your estate, get step up. And so your kids, when they receive them, can sell them without any tax consequences. Now, let's jump into two. We've talked about a bit about this, but really, if you're planning to sell appreciated assets and you don't need the money or all of the liquidity up front, it's a really good option to look at to sell the appreciated asset, defer the taxes, and reinvest the money to create more wealth for you on that side. That's just a piece of.
Yeah, if you already have a CRUT, you can reuse it.
Yes.
You can contribute more assets to the existing CRUT, and so you don't even need to create a new one if you already have one in place.
Yeah, that's a really good call out. Is you can add more assets. You can add different types of assets. We work with folks who have public stock, real estate, crypto. Even folks who've contributed artwork to these appreciated artwork before they sell. So you can kind of use this for a large range of things. The other piece is, even if you aren't planning to sell it this year, you can donate the asset this year, get the charitable deduction this year, and sell it next year. So that's also really common. Then going to, let's say you already have a CRUT, and in particular a NIM CRUT. One of the things you can do is look at how you can really, a NIM CRUT's a particular type of CRUT or charitable trust that you have some control over when you take distributions, and you can defer distributions based on how you control the trust income. And so if you do want income or don't want income, you want to make sure that you realize or don't realize enough gains this year to hit your target distribution goal. And the big benefit is, if you don't want or need the money from the trust, keeping it in the trust will allow it to keep growing tax-free and create more wealth for you in the future. So on the other hand, if you do want money, you really need to make sure that you realize enough income to cover it. So important to just kind of make sure you know your goals, and then figure out what we need to do within the trust to take care of that. Again, if you work with Valur, you have that CRUT, you can let us know and we'll help you take care of that on your side. Final kind of trust we're going to talk about for end of year optimization is non-grantor trusts. And I'll give the quick kind of preamble on this. Non-grantor trust, it's another common estate planning trust for folks worried about gift and estate taxes. It's different than intentionally defective grantor trusts in that non-grantor trusts are their own tax. They have their own tax identity and they pay their own taxes. And the one kind of unique piece is that when the non-grantor trust realizes income, it kind of has two options. There has to be taxes paid on the income, but somewhat uniquely let's say I'm the beneficiary of a non-grantor trust. If the trust keeps the income, i.e. doesn't distribute it to me, the trust will pay the taxes on the income. On the other hand, if the trust distributes that income to me, then I'll pay the taxes on the income. And so kind of taking that, Peter, am I missing anything in describing kind of this scenario?
Yeah, no, that's exactly right.
How would someone think about kind of optimizing it? Let's say they are either the trustee or beneficiary of a non-grantor trust. How can they think about optimizing these distributions to minimize capital gain taxes?
Yeah, so it's basically, you have to think about where the beneficiary's tax rate is. So if you have a beneficiary who lives in a high tax state, has a high income, it's probably not beneficial to make distributions to them if you're just thinking purely about income tax, capital gains tax. But if you have a beneficiary who is fresh out of college and lives in Texas or something, maybe you can distribute an appreciated asset to that beneficiary so that they can sell that asset and pay a low tax rate.
Yeah, exactly. And that's just really again, that's something Valur would take care of on if you work with us. But it's just a broader piece of, how do you mitigate taxes, keep more wealth in your trust, in your family, and with compounding, create a lot more wealth for your family. Now we're going to get to spend a lot of time talking about how to minimize your taxes, but kind of the next thing, really there's this idea of, it's a common phrase of, you don't want to let the tax tail wag the dog. Taxes are important, but you don't want to let taxes run your life. It's a little bit ironic coming from us, but like the broader point is, just because something can save you taxes may not mean it's the right thing in the long run. And, as an example of this, somewhat humorous, this is from Reddit. So, take that with whatever grain of salt you want to view it of. Someone who, apparently has $1 million of short-term capital gain losses in California. They posted on Reddit saying, hey, if someone has $1 million of gains, let's get married. I can use my losses to offset your gains, and we can split the tax savings. Says one, clearly a sham marriage, clearly illegal, and also ignoring the whole fact of like, this is not marital advice, but you probably don't want to get married to someone for tax savings. As much as we love tax savings, like we don't love tax savings that much. So this is just an important to like keep this in context of your larger financial goals, life. Don't let tax savings run your life. But these things, when they do fit in kind of with your broader goals or your financial situation, it really can be meaningful. But don't let it be the kind of the primary driving factor. Anything to kind of add on here, Peter?
Yeah, no, I think that's right. But if you're already planning on getting married in the next few months, you might consider getting married in December, just to give you a little bit more optionality.
Yeah, move into that marital tax bracket with slightly lower tax savings. I will say I have thought about it in that scenario. We're going to leave some time for Q&A, and just kind of as a to give a little bit of kind of just on Valur. Again, all the calculators, content on all the structures we talked about, that's all free and available on our website. We'll send over a follow-up email after this that has all of those things included. You can also set up time to chat with us for free. We don't charge anything for any of this education. Part of kind of our thesis and what we're trying to do is help more people understand these opportunities, these structures, and so that it's not just billionaires taking advantage of it. Everyone can understand and take advantage of them. And we provide free education and use technology to make it easier to access. So please let us know if you have questions, set up time with us, use these tools. As always, we love feedback of how we can do this better. And then next week, we have a webinar on ordinary income tax savings strategies to use before the end of 2025. As we're going to guess almost everyone here is probably paying more in ordinary income taxes than they would like. And so we'll talk through kind of some of those strategies you can use by the end of the year. We'll jump into, please let us know if there's any questions you have. Just add them in the chat. There's a question from Joel of, are CRUT contributions transferable from traditional investment accounts? So hopefully I'll understand this correctly, Joel. So a CRUT it's a separate account that you do set up. So it's not your traditional investment account. We do take care of that on our end if you work with us. So we'd set up a separate account, and then you would transfer the stock from your traditional investment account into the CRUT. And importantly, to get the charitable deduction this year, the transfer does have to be completed by the end of the year. But based on when it is completed, you get the charitable deduction based on the value of the stock that day. So hopefully that answers your question. If not, let us know in the chat and we'll figure that piece out.
Yeah, it's a pretty seamless process in general. So like, the typical thing is somebody has appreciated stock at Schwab. They create a trust, a CRUT. Once the CRUT's up and running, which it's very simple, then all you have to do is open an account. We would open the account in the name of the trust at Schwab. You would just do a transfer from your personal Schwab account to the trust Schwab account, and then you could sell the shares.
Yeah, exactly. And to kind of your other question, you can keep on contributing to that CRUT. There's no restriction on the types of that. Well, there's no restriction of that you can't contribute assets in the future year. You can contribute multiple times a year, contribute once a year, contribute every couple of years, you can contribute different types of assets. So there's no real constraint. And again, we've automated the trust setup process so we can get the setup done the same day. The transfer of the stock, that can take 2 to 5 business days. It's really dependent on your custodian. Some custodians work faster than others. We work pretty well with Schwab. If the assets are held in Schwab, we can sometimes get that done same day. So we'll give another minute for questions, but otherwise, again, really appreciate everyone taking the time to join. And feel free to email us directly or sign up for a call, or check out some of the content that we'll send as a follow-up, the tools to help you answer kind of any questions or dive deeper into some of these opportunities. And hopefully everyone found this helpful. Really appreciate the time and hope everyone has a great rest of their Wednesday. Take care.